And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning. Welcome to the show. Of course, it's Thursday, second best day of the week. Michael Leibowitz joining me this morning. Lots of stuff to get into. Want to talk a little bit this morning, though. My Twitter feed is filled with comments about the pig is out of the python, right? And everybody's like, woohoo, right? The pig's finally done. Well, this all revolves around this chart that came out yesterday showing that the excess savings for individuals is now over, right? So they have now depleted all those excess savings in households back from the pandemic, right? So remember all those checks we sent to households that created apparently a bunch of excess savings, which is a bit nebulous to say the least, because again, most of that excess savings was in the top 10% of income earners that saved that money. Everybody else spent it. So, whether there was a lot of excess savings is something to be debated. But anyway, it's been a topic of consideration. And of course, now that that's gone, the rumor has it, according to Jesse Felder, that the pig is now out of the python. So, sigh of relief, right? We can now have a recession. See, I don't really understand that thought process. It's like, hey, good news, pig's out of the python. We can now have a recession. That's not really great, right? If you lose your job, it's not a great thing. But nonetheless, the pig is not really out of the python because there's a couple of things that go on with that as well. Yes, consumers are running out of savings, no doubt about that. They've been spending that money, but they've also been tapping into credit card debt. Also, outside of that is billions upon billions of dollars being spent right now in terms of government spending, which is still supporting economic activity. Whether it's the CHIPS Act, the Inflation Reduction Act, where we're going to build chips plants, or we're building other types of green energy technologies, et cetera, that were all funded by the IRA. That's all still in the economy, right? That's still creating jobs, economic activity, and that's why the Atlanta Fed right now currently has GDP for the second quarter running above 4% on an annualized basis. So it's hard to suggest that the pig is actually out of the python when you have so much government spending still involved across the board. But then there's one other factor. $700 billion is the estimate right now for these buy now, pay later programs, which we don't actually have data on. Right? So, when the government talks about, issues stats out about, consumer savings and consumer credit card debt, and we see a rise in consumer credit, that's not including the $700 billion estimate. That's all, and that's just an estimate. We really don't know how much it is because companies like Affirm don't release their data to the credit reporting agencies because they're worried that when they release that data to the credit reporting agencies, like FICO, et cetera, they don't know how to process that data. They don't have a scoring system set up for it yet. So they're worried that it will impact the credit scores of consumers if that data is released. So they've been very guarded about releasing that data from companies like Affirm. So we don't really know exactly how much of that debt is sitting out there, but there's the rough estimate is about $700 billion over the next couple of years that'll continue to grow. So that's a whole nother set of spending that's been out there for consumers to latch onto that's been helping support economic activity. And this is why retail sales have continued to kind of defy expectations. It's like, oh my gosh, look how strong retail sales are. Well, that's because people are going into tapping their credit cards, they're using their excess savings, which may be or maybe not now gone. We don't really know for sure. And of course, now going to these buy now, pay later programs to buy stuff that they want. And look, these programs are not being used to go buy a new car or a new television or a new computer. Some of it is. Some of it's going to buy food, buy a loaf of bread. This is where a lot of Americans are, is they're now turning to these other sources. And we've talked about how, we've talked before about the consumer and how creative they are in terms of finding money to spend, and they will do that. So when things get tight, rather than cutting spending, they'll just find another source of debt to go into. And if you take a look at the recent survey on the buy now, pay laters, people are saying, I'm spending more than I'm supposed to. I don't have money to meet bills. These are the reasons they're tapping into buy now, pay later. It's not for going into luxury items, right? It's just going to make ends meet. But that combined with government spending, and again, we don't really have a handle on that, because when you look at the government Z1 report from the Federal Reserve that shows the different types of debt, shows mortgage debt, student loan debt, credit card debt, buy now, pay later is not in that. It's not included. So again, whole nother source of data sitting out there. It's also another source of credit risk, by the way, that we don't really know much about, right? We really don't know about the credit risk that is involved with buy now, pay later. And, is this, and I'm not making a comparison, but, there was kind of the same way with subprime mortgages back in 2007, 2008. That was about $1.5 trillion worth of subprime loans that kind of upended the entire housing market. You've now got 700 billion-ish estimate. Don't really know how much it is. And buy now, pay later. And we really don't know what the impact of that is, because we don't have any direct credit kind of statistics on that data, because again, it's not really publicly distributed. Anyway, pig's not necessarily out of the python. That's the point this morning. So anyway, let's talk about what you need to know before the bell. Then we'll get over to Michael Leibowitz here in a second. Markets sold off a little bit yesterday in the morning, rallied back into the afternoon, kind of finished flat for the day. So again, another green candle day for the market. So again, this just continues to show there are buyers entering back into the market. So again, we saw a lot of kind of selling back in April, and we talked about how the fact that sellers live higher, buyers live lower, right? So remember we had this conversation up here. Sellers were being drug out to sell. Buyers were going, I'll pay you more for it, and sellers would come out and sell. Well, as soon as sellers had kind of sold and buyers no longer wanted to buy, the buyers were down here by the 100-day moving average. And so when markets got down, and we fell pretty quickly, there was this kind of air pocket in the market, as we had talked about, is that when we get to the point that buyers kind of evaporated, that we would have this kind of air pocket in the market until we found the next level where buyers were willing to buy stock. And that was around the 100-day moving average. Since then, it's been a nice little trending rally higher. It's not been exciting. But importantly here, it is pretty amazing how quickly the volatility index has completely reversed. It took 15 sessions for the volatility index to go from basically 13 to 21. It took 13 days to go back to 13. So we've completely round-trip volatility on this market advance. So again, all that temporary little spike of fear here just completely evaporated. But again, you've got to keep this in context. This looks like a huge spike in volatility, but if we step this out to a little bit longer trend, you can barely see it. So, even the fact that that volatility ticked up to 20 is like, oh my gosh, we're at 20. It was not a very big move at all. And again, completely evaporated here in just a few days. So again, just, this whole little bout of fear, this whole little concern about this sell-off, it's now over. The correction is over for now. And again, with buybacks starting back up, we have plenty of support for the markets at this point. Retail investors are starting to pile back in already into levered ETFs, into single stock ETFs, or single stock funds. So there are, that kind of greed factor is rapidly returning. The American Association of Individual Investors, bullish sentiment is rising pretty sharply here. So again, all the supports for a rally are now kind of back in place. So that correction now officially over. We're back into a bullish trend, at least for now. Just kind of keep managing your risk accordingly, as always. That's just always kind of, rule number one. All right, that's what you need to know before the bell this morning. We'll come back, pick up with Michael Leibowitz. A lot of stuff to get into this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Michael Leibowitz joining me as well. So, of course, next week is Inflation Day. So we really haven't had a lot of economic data this week. It's been pretty quiet, kind of all around. Just really kind of, finishing up earnings for the most part. As we said, last week we pretty much clipped off 80% of the S&P 500. So now we're into just the last kind of few remnants of the S&P 500 and then a lot of other kind of non-S&P related stocks. But they're big names that you know and love, right? So we had Uber, et cetera, Robinhood, other companies like that. So, there's other names that are out there reporting and, it's just something worth paying attention to. But with a big chunk of the S&P behind us, we can now look at the earnings that came in, and not surprisingly, we had an above-average beat rate. Of course, we lowered the estimate so we could do that. That was also supported by a lot of the buybacks that was going on to help make sure that companies beat that. But what was interesting is if you actually take a look at the earnings themselves, very interesting chart out this morning I put on Twitter. If you take out the Magnificent Seven, there has been no earnings growth at all since quarter four of 2022. So for the last 2 years, there's been no earnings growth. Actually, there's negative earnings growth if you strip out the top seven. So all the earnings growth that we're talking about is all coming from just basically seven stocks. Call it just, take the top 10 stocks in the S&P 500. That is all of your earnings growth. Outside of those companies, you take those out of the index, there has basically been negative earnings growth, which would suggest that the markets would be not priced where they are currently if that was indeed the case, because earnings, the markets do follow earnings very closely, and they tend to track the trend and direction of earnings. So if you have negative earnings growth, market prices would be lower. But that's just kind of been the interesting byline coming out of earnings season. But again, it doesn't really matter at this point. Everybody's very bullish on stocks. So and again, we're seeing retail investors pile into single stock funds, taking on leverage bets, kind of doing all the things that ultimately lead to bad outcomes. They do this over and over again. It always ends up badly. Takes time to get there, but they have a hard time learning the lesson about speculating in markets, but they continue to do it. So, but real quick, Mike, any comment about that before we move on to the inflation data next week?
Yeah. It turns out it is a very kind of interesting set of earnings reports. Like you said, there's a few companies kind of leading the charge, and some of those companies are buying back shares. So even their earnings per share are distorted because of the buybacks. So it's hard to kind of, look at the earnings in totality without factoring in the buybacks. But you're right that it is the big companies. And what's interesting is that the companies like yesterday, for instance, it was Uber and Shopify. I think Shopify was down about 20%. Yep. Uber was down almost 10%. And we've had a lot of companies that are down 10% or more on earnings. And at first glance, it seems like companies are getting punished more so this quarter than we've seen. Mm-hmm. But it's hard to tell, based on kind of what you see. But it turns out that those companies are down, that companies that have underperformed are on average down 5.1%. Typically, it's about 2.4%. And companies that have beat earnings haven't been up as much, although it's much closer. I believe the average is 1.5%, and they were up 1 or 1.1%. We wrote about that in the commentary that comes out this morning. But so the bottom line is a lot of companies are getting punished for bad earnings, but the Magnificent Seven are leading in both earnings and helping keep stock prices probably higher than where they would be. But we have seen some of the punishment doled out to some of the Magnificent Seven as well. Yeah.
And too, just, by the way, we did see stocks that had up days much bigger than, 1 or 2%. We saw Apple up 7%. But again, in totality, to your point, the average has been, kind of a, not great rewards, but brutal punishment if you missed earnings. And I thought it was interesting yesterday when you look at Uber and you look at Shopify as an example, and as I was just talking about the kind of the excess savings, there is a lot of signage that is popping up in some of the earnings data that suggests the consumer is really starting to slow down here a bit. I mean, Uber is a good example of that. Shopify, which is very discretionary items. I mean, you don't go to Shopify for necessities, right? I mean, that is purely the $500 cutting board that somebody made in their garage, right? So I mean, purely accessory, pretty kind of accessory type stuff. But interestingly, that's where you would kind of expect that early impact of potentially a consumer slowdown to start to manifest itself. And again, not making any assessments on one quarter's worth of earnings, but I think that does speak to a lot of this data that we've been talking about for a while, that that kind of lag effect of higher interest rates and slower economic growth, which is feeding through, is starting to show up in companies' bottom lines, and that's where you would expect it to show up.
Right. Starbucks is kind of my favorite in that category to keep an eye on, because they're it's sort of a luxury. You can make coffee at home or in the office for 50 cents at home, and you get it free in the office in most places. So, it's easy to cut back on Starbucks, and it's a nice luxury to go get coffee, even though it's $3, $4, $5, but it's not going to break you. So when Starbucks is telling us that their same store sales are down decently and they're having sales issues, that means that customers on the margin are starting to pull back a little. It's very easy to pull back on a cup of coffee, right? You can save $4 a day, whatever it is, and not really, dent what you're saving, but it feels good that you're doing something. So, as we go through this quarter and next quarter, we're going to look at these consumer companies, especially the discretionary ones, and probably the cheaper side of the discretionary ones, to see if consumers are truly pulling back, or if it's just they spent a lot more money than they wanted to during Christmas, so they were pulling back in the first quarter to kind of make up for some of that.
Yeah, I thought McDonald's was interesting because McDonald's reported pretty poor results as well. That stock was also punished pretty decently. Right. And I thought their response was great, which was, well, we'll come out with a bigger burger. I don't know how a bigger burger, which you're going to charge more for, is going to solve your problem. But hey, it's worth a shot, right?
Right. And McDonald's is always a tricky one, right? People, you can eat at McDonald's cheaper and you can make anything at home.
Have you been to McDonald's lately?
No.
Okay. Well, I tell you what, for lunch today, go to McDonald's and order lunch. And then you tell me tomorrow that you could eat cheaper at McDonald's than at home.
It's not cheap eating at home either. Like in the grocery store.
No, I'm just saying. But, when you go to the grocery store, you buy food for a week. So you break it down into meal sizes. It's a lot less. But I'm just saying McDonald's is not cheap anymore. Used to, I could go to McDonald's and feed my kids, for 4 kids for $20, and that is not happening. I mean, it's like a meal is $16 now. So it's getting pretty pricey. Plus, especially if you live in California.
Well, my son was telling me Five Guys is now over $20 if he wants French fries with the burger.
Yeah, that's why I go to Three Guys for the discount. So, this all kind of leads. By the way, this all kind of leads to our next topic that we'll catch up to after the break, which is inflation. We have the CPI report next week. And it was interesting this morning in the Daily Shot, they actually have a chart of showing rents. So Mike has talked a lot about rents lately, and this will be something we'll talk about in the next segment. But it was interesting because so when you sign a rental agreement, right, your rent doesn't change for a year or 18 months or however long you sign your rental agreement for. So every month there are rental agreements that are coming due and they're getting re-signed. And this is and there's a very important point there's really kind of 2 important points about this, is that this is why there's this kind of lag effect of rents that are catching up into the CPI report because of the stability of rents for a period of time. But what we'll talk about when we come back from the break is in this data, there was really 2 important points in the data itself about the re-signing of rental agreements and how that is then ultimately going to show up into inflation. But we'll talk about that when we come back from the break here in a second. But Mike, before we jump off of this, give me a quick 1, 2, 3 on your article that's on the website right now.
So it's I had to remember there. It's a day old, Lance.
I've slept since yesterday.
There was a very interesting article that the Wall Street Journal put out showing how Buffett and Berkshire Hathaway came about to buying so many Apple how much a huge percentage of Apple. And it comes down to that Buffett challenged one of his portfolio managers with a scan, find companies that meet this certain criteria. So what we did is explain Buffett's position and how much of Apple they own, and then we do the scan. And shockingly, because it's a pretty simple scan, and my guess is I was going to find 20 companies that met it, there were only 2, and 1 sort of met it. So, trying to find value with growth is a lot harder than you think it is, especially in this market where valuations are high. That's kind of the high-level takeaway of the article.
And I thought it was interesting. So I'm kind of doing a different take on it, looking at Buffett's cash. Of course, in his recent report, they reported almost $180 billion in cash on their balance sheet. It's expected to be $200 billion by the end of next quarter. What could he have done with that cash as a better alternative? So I'm working on that article now. That'll be out sometime next week. All right, when we come back, we'll talk about inflation and this latest rental data and why it's so important to the overall number, especially for you people in chat that are expecting inflation to go up. We'll talk about that next. Don't go away.
The real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Gen Zs are now rediscovering old stuff.
Yeah.
Camcorders and flip phones. See, I think Apple's missing it. They need to come out with a flip phone.
That would be brilliant.
Yeah, when you flip open the phone, it plays 90s music. They're rediscovering 90s music.
The Real Investment Show podcast. Same show, your schedule.
They're not discovering good music, right? They need to go back 10 more years, get to the 80s.
At realinvestmentadvice.com.
Get to some good music.
70s.
No, not the 70s, Brent. 80s.
I'm with you, Brent.
60s.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, as I said, next week is the big inflation report. And, of course, a lot of people are still concerned about higher inflation and, inflation rates are going to go up and that's going to drive yields higher. But, again, there's a lot of data that's coming through that suggests that that may not be the case. And there's really kind of two big factors. We'll talk about both a little bit this morning. In fact, I'm writing about one this weekend in particular called residual seasonality. But the first one is rentals, rental income. And as I was saying just for the break, that when you sign a rental agreement for an apartment, for a house, whatever it is, it's fixed for a set period of time. So just a good example of this, my wife and I sold our house in July a couple of years ago, and we've been renting ever since. Well, we signed a 2-year lease agreement on the house because we knew we were going to be buying another house. We just didn't know where or when, and we were kind of waiting for the housing process to kind of go through its cycle. So we wound up buying a house, we're remodeling it, right? So so our rental agreement is coming due in July, and we'll move into our new house at that point. But our rent has not changed in 2 years. So our inflation on rent has been zero for the last 2 years. So when that feeds through into the inflation data, right? My rent, then if I was the sole determinant of rental inflation for the entire country, my rent would have not changed for 2 years. So there'd be zero inflation in rent in that environment. Well, if you actually take a look at the rental data, which was out today, there is a very interesting. The renewals on rents are about the same as they were this time last year. Actually, they're just slightly lower. But let's just call it zero, which means that rent has had no inflation over the last 12 months, right? Because again, it doesn't matter if rent's still high, because it is, right? So if you're paying $1,200 for an apartment or $1,500 or $2,000, whatever the number is, that's still a high number. But if it's the same number a year later, if you re-sign your rental agreement and it's still $2,000 a month, inflation is zero. Yes, prices are still high. No doubt about it. That's eating into your budget, right? But the inflation rate is zero because it's the same as it was last year. And so if you take a look at the actual rental rates and the rental indexes that go into calculating CPI, it's basically about zero. Actually, there's a slight deflation in that data. So, Mike, how is that going to potentially impact the inflation report? Maybe this report for March is too soon, but for April, for the April report is too soon. But are we going to start to see more of a impact towards inflation because of rentals in the months ahead?
It's part of the problem is the CPI is a black box. So we know that within the CPI data, 40% of it is basically this rent information. And we know from many companies, companies like Redfin, that rents are, at best case flat, but like you said, probably negative year over year. So it's a question of when will the CPI data catch up to the real world data. And, we are starting to hear that rents are starting to increase a little bit. And I'm hearing this, oh, no, there's more inflation coming because rents are increasing. And that may be right, but that's a story for 9 months from now, for a year from now. Right now, we're waiting for CPI to catch up with data from the fact that rents have basically completely stabilized, if not fallen, over the last year. Mm-hmm. So, I suspect that over the next 3 months, we could see it this month. We may have to wait till July, August, that 40% of CPI is going to start dropping. Right now, they're showing inflation rates of about 5% for rent. And again, we know it's zero. So it's having a huge effect on CPI. And when it comes down, it will equally have a big effect on CPI. And part of the problem from more of a kind of markets trading perspective is, will it come down? So will the number next, I think it's Wednesday or Thursday, show a sharp drop in rent inflation, or will they revise prior months lower? And, how that happens can have an effect on the market. But again, CPI, purely because of the rent number, should be coming down. Obviously, there's a lot of other factors, and you're going to be writing about the seasonality factor. But, we're past the new year, and there's a lot of seasonal adjustments. A lot of insurances are updated, the cost of living, wages, and everything associated with that. And we're past that point. So we should expect lower inflation. The street is expecting lower inflation. The estimates right now are 0.3 on a monthly basis, but there are a lot of Wall Street analysts thinking that comes in below that. So we should get more favorable news on that front, which then should probably allow the Fed to talk in a more dovish manner, meaning that rate cuts will be back on the table probably later in the year. But, it should be a more bullish setup for the bond market, which will probably relay to the stock market as well.
Yeah. And there's one other factor here too, which is, as I mentioned, I'm writing about this, I'm touching on it in this weekend's newsletter. In this weekend's newsletter, we're kind of going through a lot about this rally in the market and what's going on with it. But part of that I touch on is what is this anomaly called residual seasonality. And, we talk a lot about the data. and all the adjustments that are done to this data through mathematical calculations. And that's the seasonality. When we always hear about it, being seasonally adjusted versus non-seasonally adjusted data. Housing is a great example of this. Mike and I talk about this quite a bit. If you take a look at existing home sales, they'll say existing home sales were up, 5,000 homes, whatever. But actually, if you look at the number of homes, that's seasonally adjusted, right? But the reality is, if you actually go look at how many homes were actually sold, it was like 12. So, so there's this big difference between what actually happens with the data versus how they seasonally adjust it with the math. Well, the problem is that sometimes and especially when you go through a period like the pandemic where we just kind of really screw things up because we shut down the economy or we inject a lot of capital into the economy, and that causes variations to the data that is not accurately calculated or caught by the seasonal adjustment. So in the first quarter, some of this data has been kind of, really belying the underlying thing that we can kind of see with our vision, right? We're talking about Uber, we're talking about, Planet Fitness. That's a total discretionary spend right there to go work out at a gym. Big miss on their revenues as well. So we're seeing all this evidence that the consumer is slowing down, but the data is still very strong. Part of that is this outsized adjustment that is happening in the data right now, and that will get revised back out again over the course of the rest of this year. So a lot of this first quarter strength that we're seeing in some of the economic data will start to reverse as well. And I think, Mike, the Fed is aware of this. This isn't some hidden little factor that nobody knows about. This is pretty normal. The Fed knows about this. And I think that's one of the reasons, what we're talking about here is two of the reasons. And this was kind of my conundrum I asked you about several times here on the show. Is like, I don't understand why the Fed would cut rates. Economy's strong, unemployment is very low. This is not the time to cut rates. And you were like, well, maybe the Fed sees a liquidity crisis coming or something like that. And, potentially what the Fed is seeing, and the reason they've really been adamant about not hiking rates, potentially starting to reduce QT, starting to cut rates later on, is because of they're seeing this slowdown in inflation, this residual seasonality that's going to start coming out of the data, and we're about to start getting a spat of weaker data as we get, later on into the year.
Yeah, and we wrote about this in today's commentary. The consumer should start weakening pretty soon here. Real wages are falling. Savings all the excess savings from the pandemic are now gone. And the savings rate is the lowest it's been in about 15 years. Credit card debt is up. Buy now, pay later debt is up. So a lot of consumers are being pushed hard. And that's why we're seeing Starbucks, McDonald's, all these Shopify, all these companies we've talked about are starting to struggle because they're at the lower end of the spending chain. When you go to the upper end, the wealthy have plenty of money. Lance, we have both written about this. They're the ones that own the stocks. They're the ones that are seeing their wages increase, real wages increase. So you have a huge divergence in the wealth, and it makes all these statistics very difficult, like house sales. There aren't many houses that are selling. There are just not many houses on the market, so not many are selling. But the ones that are selling are the higher priced houses, because the mortgage rate doesn't matter for someone with a lot of money, someone that can afford, a high mortgage. That high mortgage rate really matters for the first-time home buyer and for the lower portion of the market, where every dime counts when they're trying to buy a home. So, the data is really kind of screwy. But I think, given that consumption is 2/3 of the economy, and what we're seeing from a lot of these retail type store earnings, that we're going to start seeing more of a headwind coming from personal consumption.
Yeah. And look, and none of the stuff that we're talking about here doesn't mean that we can't have a hot CPI print next week, right? I mean, we're still in that phase of that data where these kind of outsized seasonal adjustments are still factoring in. So we could very well see a hotter than expected CPI print in next week. But later this year, the impact of rent itself, just by itself, which is roughly a little bit more than 40% of the CPI index, that elephant in the room by itself will pull inflation lower. But that's just the important thing about it. All right, quick break. We're going to come back, get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show. So it's interesting, again, while Mike and I are talking about, the impact of credit and what's happening with the consumer and things that we're just, and this is just data that Mike and I are watching, right? So, all Mike and I do all day is just analyze data. That's our whole job for the most part. So again, there's sentiment. It's how we feel about things. And then there's just data. And data kind of sometimes tells you a different story versus how you feel. And this is always one of the big debates, right? And this is, especially when you talk about inflation. Inflation is always a very emotional discussion. It's like politics, right? You don't talk about politics, religion, or inflation over the dinner table, right? Because it's just very emotionally charged. Because immediately if you say, well, inflation is cooling off. It's like, have you been to the store lately, right? Have you bought this? Have you gone here? Have you done this, right? And I, again, I get all that, right? And I certainly understand. I live it just like everybody else does. I have to pay for food. I have to pay for gas and all these type of things. So, I get that, right? It's a very charged issue, but there's not a good measure for inflation because inflation is different everywhere you go in the country. Mike's inflation where he lives in liberal land is a lot higher than where it is in Texas, right, where cost of living is cheaper. Higher in California than it is in Florida, as an example. So it also depends on your age, right? So if you're younger, your cost of living is cheaper than if you're middle-aged or older, right? So there's all these different impacts. So there's no one good gauge that gauges inflation. So what we have to do is just find a measure that we can all kind of agree is a general assumption about inflation or economic growth or whatever it is. Here's the point I want to get to. When it comes to investing, How you feel personally does not matter. It has no bearing on the market or your money or anything else. So you can run around all day long and scream at the top of your lungs about how high inflation is, and that's fine. But that has no bearing on the market. All the market cares about is official government data. They care about the employment data. They care, and when I'm talking about the employment data, I'm talking about what's reported by the BLS. That employment number on Friday, once a month, that's the number. The GDP number, that's the number, right? Doesn't matter what you think. Doesn't matter how you feel. What matters is what's reported, because that's what the market operates off of. So so it's important to dissect those two things, right? Nothing wrong with about the way you feel, right? I complain about inflation at my house all the time. I yell at my wife. And then I don't really yell at her. I don't really say anything because she'll yell back at me. But in my mind, I'm yelling about how much stuff is costing. And then I just go on about my business. But when it comes to investing, Mike understands this. He's the same way. Mike and I have a lot of arguments in our head that never leave into verbal space with our wives.
Fighting each other.
Exactly. But when it comes to investing, it's important to just focus on the data that the market cares about. And you'll be better as an investor over time if you do that. And again, that's the important thing. Because again, we're just talking about, about this lending issue. Article in the Wall Street Journal. Lenders are seeing a bottom for consumers, right? So here's just a complete 180 turn on what we were just talking about. The fact that we're seeing rising delinquencies in auto loans. We're seeing rising delinquencies in credit cards. We don't have any idea what the charge-off rate is for buy now, pay later, because that's really not reported. But lenders are starting to feel more confident that we're returning to normal now after this big resurgent. We had this big flood of stimulus. That stimulus is now all worked out to the system, and now lenders are going, okay, we're back to normal. We know what we're dealing with. So we can get back to just kind of lending on a normal basis to consumers. So they're seeing a very different picture in terms of their environment. Banks have been much more optimistic. CEO confidence is rising, right? So there's a lot of things that suggest that things are more optimistic than even the data that Mike and I were just talking about a few minutes ago. Mike?
Now, here's a great example. A lot of people do not feel good about the economy. Biden's economic confidence numbers are very low, even among Democrats. Let's just focus on Democrats who are supportive of Biden. They're very low, despite an economy that is about 0.5% above its normal trend, unemployment near 50-year lows, right? So it's telling you that a lot of people don't feel good about the economy. And it's not political because, again, we're just looking at Democratic polling. But what's the stock market been doing for the last year and a half? It's been going up. So you have polls going down and stock market going up. They're divorced, right? There's a lot that drives the stock market. It's liquidity, which we talk about all the time. It's stock buybacks that we talk about a lot. But there's a lot of factors, and there's just narratives, right? AI is going to save the day. It's going to be the greatest thing since the internet. And that will propel the stock market as well. So again, you have to divorce your personal feelings. And at times you even have to divorce the feelings of the broader population. Inflation's another good example, Lance. Very few people really understand inflation. So you go to the supermarket and the price of bread is $8. It used to be $5. They're all wondering when's it going to come down to $5, and it's $8, and that's why Biden's doing a crappy job on the economy, right? The bottom line is it's not. It's at $8 now. That's your baseline. And if it stays at $8 next year, like you said earlier, we have 0% inflation. And if we have 0% inflation, the Fed's going to be crying for more inflation. And they're going to be doing things to create more inflation. So we have this whole disjointed economy that's happened over the last few years. And I just feel like our gauge of it is just very off, largely because of inflation. And, you have to divorce those feelings from your investments. And it's hard. It's very hard for the best of professionals. And it's certainly hard for, people that don't really understand what they're doing in the investment world.
Well, and again, and it's interesting. So I'm just kind of, as you were rambling there, I was kind of looking through the chat. And it's interesting, there's just comments about, fundamentals and issues, with the markets. And again, this is the hard part about investing, because it's become really a market where fundamentals don't matter as much. And, you and I have our anathema in the market, which is CVS, right? Super fundamentally cheap company, growing earnings, in the middle of the healthcare space. Everybody's getting older. Every time you need medication, you go to a CVS to get your medication filled. They're vertically integrated from the pharmacies all the way up through the healthcare process itself, but yet the stock is just one disaster after another because of market sentiment, right? Has nothing really to do with the fundamentals. And then you look at a company like Apple as a good example, right, which hasn't grown revenue in 6 years, but the stock goes up 7% because, it's Apple and it's 35% of the index, right? It's in that top 35% of the index. So every time there's money going into an ETF, it flows primarily into Apple, Microsoft, Google, et cetera. So, this whole idea that fundamentals matter has gotten much more challenging in recent years. In particular, I think more so in the last 5 years than it was in the 5 years previous to that. But really post the financial crisis, because of the massive surge in buybacks, because of the massive, inductions of capital through quantitative easing, zero interest rates, we've distorted the market so far away from fundamentals that it's become much more challenging to be an investor without just being almost a pure speculator and just buying whatever's going up.
Yeah, and I think a different way to kind of think about it is a lot of people say valuations matter. And what I'm going to say here is valuations really matter, but not in a traditional sense. They matter in that a typical valuation is like price divided by earnings. And you get a ratio, say 20-1. So the price is 20 times the earnings. What matters for the price of that stock is both the P and the E. So if the earnings are unchanged, the valuation will still change. It may go to 18, it could go to 22. So you're lumping in everything else besides earnings into the price of that stock. So you look at valuations, just like house prices. These houses are not worth what they're going for, but it's what people are willing to pay for them. And it's just like stocks. It's like the market for anything. It was like those crypto art NFTs.
Right.
It doesn't matter that they're worth zero. They if you were to do their price to earnings, the earnings are zero. But people are willing to pay, in some cases, hundreds of thousands or millions of dollars. So, it's a market, and it's going to be driven by psychology of the market participants, and valuations are what you should be watching. And just because the valuation is high doesn't mean it can't go a lot higher. And just like CVS, a valuation is low, it can get even lower. Even earnings can climb. But if people don't like the stock for whatever reason, whether it's rational or irrational, it will do whatever it's doing, whether that's falling or rising in some cases.
Exactly. So just real quick, as we close up, for the last several years, I've been talking about the fact that the move to unbundle services would eventually lead to rebundling. That has now happened. Disney and Warner Brothers are teaming up to provide a bundled service because they can't sell enough subscribers on their own. So again, the end result of this is ultimately we will all move back to bundles. And the whole move to unbundle just became a massive fee suck that now is going to reverse back into, hey, bring me your business, bring me your dollars, and I'll give you more value for your money. So there you go. It's already starting to happen. All right. Wraps up the show for the day. Have a great day. And tomorrow, Danny Ratliff and Richard Russell here from Financial Fitness Friday. Newsletter out this weekend on what's driving the market. And, of course, article out tomorrow on the markets as well, talking about the perfect investment. That's tomorrow's article on the website, realinvestmentadvice.com. See you next time.